Hi, I'm Matimu Ngobeni, an actuarial specialist at Salam Corporate Investments. In today's update, I'll be taking you through the macroeconomic developments and how local and global markets have performed during the third quarter of 2024. The past quarter has been quite eventful for both global and local financial markets, with major shifts driven by key macroeconomic policy changes. In September, more than 20 central banks worldwide cut rates, creating a relief for consumers. In the United States, the Federal Reserve surprised markets with an aggressive 50 basis point interest rate cuts. The People's Bank of China announced broad policy easing measures to shore up a flailing economy. The measures included rate cuts and support for the struggling property sector. On the flip side, geopolitical tensions remain a concern. Conflicts in Ukraine and the Middle East are still ongoing, with the situation in the Middle East escalating into Lebanon and potentially beyond. The market's reaction to these events have been short-lived, but as the situation escalates, we would expect to see moves to a more risk-off environment. In the political sphere, the United States presidential election is now just some few days away. The race is tight, and as always, the result will likely come down to a few key swing states. While we can't predict the outcome or the immediate impact on the markets, it's something we'll be watching closely. Here at home, inflation decreased to 4.4% year-on-year in August, below the sub-midpoint target of 4.5%. The South African Reserve Bank cut rates by a 25 basis point. With inflation well contained and a stronger rand and falling oil prices, we expect more rate cuts in the near future. The absence of load shedding has clearly helped to lift the mood for most citizens. Although developed market equities measured by the MSCI World Index performed well in United States dollars, driven by growing consensus that inflation is largely contained, this was overshadowed by 5.6% appreciation of the rand over the quarter. Therefore, the performance in rand terms was a modest 0.4%. Emerging markets equities measured by the MSCI Emerging Markets Index staged a strong comeback in September, primarily fueled by gains in China and South Africa. However, the strength of the rand eroded some of these gains, resulting in 1% return for the quarter. Over the long term, both developed and emerging markets have done well, with developed market equities posting double-digit returns throughout. Here at home, improved sentiments from a market-friendly election, better economic conditions, and easing monetary policy led to gains in asset prices and the rand, with the JSE All-Share Index rising 9.6% in rand terms. Key contributors included listed property 18.7%, financials 14.3%, while resources declined by 1.5%. Industrials was one of the standout performers, benefiting from the month-end China's rally, as Naspers and Prosus reacted to the strong move in Tencent share prices. South African nominal bonds performed strongly, with the All Bond Index rising 10.5% in rand over the quarter and adding more positive returns to the total for the year. Over the long term, local asset performance is decent. In conclusion, the past quarter saw significant developments across global and local financial markets, driven by key macroeconomic policy changes and geopolitical events. Central banks globally adopted rate cuts to provide economic relief. However, geopolitical tensions in Ukraine and the Middle East remains a concern, with the potential to shift the markets toward a more risk-off stance should conflicts escalate further. Locally, South Africa benefited from improved sentiments due to election results, easing inflation, and potential market performance, particularly in listed property and financials. Both developed and emerging markets showed resilience, setting a positive outlook for the future. Thank you for your attention.